Welcome, incoming Masters of Finance students. Think of your upcoming 15-credit module, Advanced Managerial and Financial Accounting, as, well, a bit of an intellectual expedition. We're climbing a mountain of financial strategy together in this explainer, and by the time we hit the summit, you're going to see the corporate world from a razor-sharp vantage point. Let's get started. Okay, let's dive into the map of our journey. We'll start with our destination and aims, move into core concepts, navigate costing and decisions, climb into strategy and control, and finally cover your assessment and grading. Section 1. The destination, aims, and objectives. So this module is a robust 15 credits, and it has a very specific mission. It's designed to give you a comprehensive grounding in the main techniques and underlying concepts of accounting statements. But listen, we aren't just memorizing formulas here. No way. We're going to truly understand the objectives, the functions, and the actual real-world processes that generate accounting information. And more importantly, we're going to look closely at who exactly uses this financial information across various businesses and how they use it to flat-out win. Section 2. Navigating the terrain. Core accounting concepts. Now, what's really interesting here is the distinct line drawn between two completely different financial worlds. Financial accounting is primarily outward-looking, right? It's for the investors, the regulators, the public. But management accounting, that is the internal engine. It's the secret playbook organizations use behind closed doors to plan, evaluate, and control their operations. Grasping that management role is your absolute first step to thinking like a true financial strategist. And to be that strategist, you really need to nail down cost objects. You've got direct costs, things you can easily, literally trace right to a product, like the steel used in a bicycle. Then you have indirect costs, like the electricity used to light the entire factory, which are way harder to pin down. Alongside this, we'll be exploring the crucial dichotomy between fixed costs, which stay exactly the same no matter how much you produce, and variable costs, which fluctuate right along with your volume.
Let's bring this to life with a quick micro-narrative. Imagine a single cost flowing through an enterprise. It starts out as raw materials inventory, say a pile of lumber. Then, as it moves into the production process, it accumulates labor and overhead. Finally, it emerges on the other side. But here's the trick. Is it a product cost, tied to the physical good and sitting on the balance sheet? Or is it a period cost, like a CEO's salary, which is expensed immediately on the income statement? Mastering this flow is absolutely vital.
Section 3. Deeper terrain, costing and decision-making.
I actually want to pose this exact syllabus question directly to you right now. What does the cost, volume, profit, or CVP model actually do? Why do managers completely obsess over it? So the crucial point is that CVP is basically the ultimate what-if tool. It tells you exactly how changes in your costs and your sales volume will impact your bottom line. Alongside other building block concepts like job costing, which you use for custom, unique products, and process costing, used for mass-produced goods, CVP forms the total bedrock of product costing systems. We'll also look at how trying to recover fixed capacity costs can sometimes lead to a nasty death spiral of price increases and plummeting demand. It's fascinating stuff. Which leads us to a massive evolution in accounting. What really is the difference between activity-based costing, or ABC, and traditional cost systems? Well, traditional costing often just smears indirect costs across products like peanut butter, which honestly can wildly distort reality. ABC changes the game. It identifies specific activities like machine setups or quality inspections and assigns costs based on how much of that activity a product actually consumes. When would a company benefit most from this? Usually when they have highly diverse product lines and really high overhead. It dramatically improves decision-making by showing you exactly where your money is bleeding. Speaking of decision-making, let me ask you this. Why are sunk costs totally irrelevant? See, when making decisions about the future, you have to focus on relevant information. Money you've already spent and cannot get back, that's your sunk cost, should not influence your next move. Instead, we use opportunity costs, the value of the next best alternative you just gave up, and weigh them against outlay costs. This mental shift alone is going to make you a much sharper business leader.
Section 4. Climbing higher, strategy and control.
Let's move on and see how this all builds the framework for corporate control. It starts with budgeting, which usually kicks off from a single starting point, the sales forecast. From there, we'll walk through the actual mechanical process of building a budget. But it isn't just numbers. We're going to look heavily at the behavioral aspects. How do people act when they're handed a budget? And crucially, how should budgets relate to human compensation? If you get this wrong, you can accidentally incentivize some pretty disastrous behavior. To prevent that bad behavior, companies need really good performance measurement systems. This brings us to a massively popular tool, the balanced scorecard. What actually makes a measurement system good? Well, it can't just be financial. The balanced scorecard forces managers to look at financial metrics right alongside customer satisfaction, internal processes, and learning and growth. We'll examine why this is so beneficial, but also those common pitfalls and traps companies fall into when trying to implement it. And this brilliantly illustrates how we evaluate responsibility centers. We rely on 4 heavy hitters of performance measurement: return on investment, residual income, economic value added, and return on sales. Each of these has distinct advantages, but also some rather dangerous drawbacks. We're going to dissect all of them so you know exactly which metric to deploy. Wrapping up this strategic section, we will cover the 4 basic forms of those responsibility centers: cost, revenue, profit, and investment. Then we use the DuPont method, basically breaking down ROI into its specific component parts to see exactly what is driving profitability. From there, we tackle the costs and benefits of decentralization. And finally, we dive into the notoriously tricky world of transfer pricing, how divisions within the exact same company charge each other for goods, and the vital guidelines for setting those minimum internal prices. Section 5, the expedition gear, assessment and grading. Okay, there is a really stark split here. 60% of your grade comes from assignments and only 40% from the final examination. This is incredibly important. You absolutely cannot just sit back, listen to lectures, and hope to cram at the end of the term. The absolute majority of your success in this module is determined by the work you do day in and day out. So what does that 60% actually look like? Well, it means daily practical group classwork. It means a daily individual presentation where you'll be expected to stand up and articulate these complex financial concepts clearly. And it means handing in practical presented coursework assignments constantly. You're going to be practicing these skills out loud and on paper every single day before you ever step foot into that 40% final examination. It's going to be demanding for sure, and it's going to be incredibly fast-paced, but I promise you the view from the top is absolutely worth it. So I leave you with this final thought. Are you ready to master the financial languages that drive global business? Welcome again to the Masters of Finance program. Get some rest, grab your gear, and I will see you in our very first class.